It happens that whenever crowd is focused on one asset or is in love with one asset and the momentum is there, it becomes a glamour asset to be in, people overvalue it, expectations are very high. At the same time, on the other hand, there will be some asset or a theme or a sector which is getting underpriced because it's just being ignored by people. It's not exciting for them in the short term. And that's where you should go fishing. Crowd is right on trends, but it is wrong at ends. So you have to wait for the right overreaction by the crowd and then take advantage of it. That forms the kind of a foundation of my thinking. In 2004, for example, markets hit two lower circuits when the election results were not as what the market was expecting. We were expecting BJP with India shining, and then we had Congress with a group of other parties forming the government. That was again, in hindsight, that was a brilliant buying opportunity. People had overreacted quite negatively. Greed is going up and patience is coming down. People have seen very good returns in the last 3 years. And now there is greed to take more and more returns for every move. So people are moving into F&O or leveraging and putting probably a substantially large part of their asset on, say, short-term movements. And patience is low. Any company, a good company, if it is going through a temporary low patch, even if the future of that company is great or a sector, people are ignoring those. And I think that's where the opportunity is.
You can have three kinds of edges in the market. One is the informational edge, one is the analytical edge, and the third is the behavioral edge. Bajaj Mutual Fund has prided itself on establishing the behavioral edge as its USP, and the man who's established it there, Nimesh Chandan, has worked on it for a long time. Nimesh, it's a pleasure to have you here today. We will discuss first your portfolio and then your investing philosophy as well. So before we begin, before we come to the present actually, can you give us some background on your career and how that has evolved?
So I've been part of the Indian capital markets now for 24 years almost. I started my career as a research analyst for a company called Strategic Capital, StratCap Securities. I was the first equity analyst for that company. Business was about institutional broking and investment banking. Till 2003, I was looking at IT sector and then pharmaceuticals post that. In 2003 end, I came across the term behavioral finance and started reading about that, went through some research papers. And I got very intrigued by it and saw it as a common thread that connects all the good investors that I admire. And so I decided that I need to pursue learning in behavioral finance. But being in the sell side job where you just write recommendations and send it to clients, I thought that will not really suffice in making me understand the psychology when you actually make the investment. So I decided to come to the buy side from the sell side and look for a job in the mutual fund side. I was actually following Saraswati rather than Lakshmi to come here. Thankfully, Lakshmi followed. Then I've spent about 17 years here in the mutual fund industry. 14 out of that have been in my previous company, which is Canara Robeco. And the last 2 years in Bajaj, where we have established our AMC on the behavioral edge, as you mentioned, where we incorporate tools and ideas from behavioral finance and use them to reduce our own behavioral mistakes as well as take advantage of the crowd's mistakes.
So Nimesh, can you give us examples of when you applied this in the past in your own investing journey?
I entered the market in the year 2000, and you remember how the 2-3 years were for equity markets. Especially, I remember a date, April 10, 2003. I was an IT analyst, and Infosys that year or that day fell by 40% in a day because of the bad guidance or disappointing guidance compared to what the street was expecting. Some of my colleagues came and told me, so now what will you do? Right? Nobody will require an IT analyst. But there was so much fear. Valuations had become attractive for that stock. And later on, in hindsight, I realized that that was the best buying opportunity for that company because the market had severely overreacted on the downside. And post that, Infosys actually became a multi-bagger. So some of these lessons, when I saw the market being either too greedy or too fearful, that had an impact on my thinking a lot. And maybe there is always a slight contrarian streak in me that my style developed as waiting for the right opportunities where the crowd overreacts. And it always happens every few years in every asset class. Every asset class gives you a loose delivery to hit a six or a boundary. That's what I do. I wait as a contrarian. So a large part of my thinking is contrarian. Not just being against the crowd. Crowd is right on trends, but it is wrong at ends. So you have to wait for the right overreaction by the crowd and then take advantage of it. That forms the kind of a foundation of my thinking.
When we spoke earlier, you said it's a bit like a crocodile lying in wait. So can you give us a few more examples of these turning points that you've seen in your own investing journey?
If I talk about the asset class as a whole in equities, say, you saw in 2004, for example, markets hit two lower circuits when the election results were not as what the market was expecting. We were expecting BJP with India shining, and then we had Congress with a group of other parties forming the government. That was, again, in hindsight, that was a brilliant buying opportunity. People had overreacted quite negatively. In 2006, when Fed was increasing interest rates, I remember the Sensex had come down from some 12,800 to 8,800 within a matter of 2-3 months. Ironically, that was the first quarter when India actually had more than 9% GDP growth rate. But people ignored that. People were fearful of liquidity and coming bear market or so. 2008, obviously, the financial crisis, there was reason for the market to fall. But at some point of time, it was over-exaggerated because India's fundamentals or economy was not that affected. Same you can see in 2011 during, say, the Euro credit crisis, 2013, the taper tantrum, demon, many of these incidents, and COVID at the end. These were equity market opportunities that came almost every 2-3 years. Fixed income, I can think of one big opportunity that I don't know how many people capitalized on, but something that I had put in my portfolio. A few years back, 7-8 years back, there were these tax-free bonds which were yielding 7.5 to 8% tax-free. And the tenures of those bonds were 15 years, 20 years. And at least I thought that was a fantastic time to lock in a yield for a longer term. So my large part of my fixed income portfolio is these tax-free bonds, which have an average yield of about 7.8%.
It's fantastic.
Yeah. So it happens that whenever crowd is focused on one asset or is in love with one asset and the momentum is there, it becomes a glamour asset to be in, people overvalue it, expectations are very high. At the same time, on the other hand, there will be some asset or a theme or a sector which is getting underpriced because it's just being ignored by people. It's not exciting for them in the short term. And that's where you should go fishing. That's where, as Charlie Munger said, there will be more fishes and less water, and your success rate will be better.
So if you had to turn your mind to the present juncture,
so
what is the crowd in love with?
In the present time, I feel that greed is going up and patience is coming down. People have seen very good returns in the last 3 years, and now there is greed to take more and more returns for every move. So people are moving into F&O or leveraging and putting probably a substantially large part of their asset on, say, short-term movements. And patience is low. Any company, a good company, if it is going through a temporary low patch, even if the future of that company is great or a sector, people are ignoring those. And I think that's where the opportunity is. We identified quality as a style where the premium of quality stocks compared to the market has become quite low. Okay. So that spread has become quite thin. And purely because a lot of these quality stocks in, say, private banks or consumer stocks have not done well in the last year. The numbers were below expectations. But within this pool, there are many which are structural stories, and you can take advantage of the
So quality is where you go to fish.
Absolutely, yeah.
So now let's turn to your own portfolio. What is the asset allocation there?
As I said, I look at opportunities to invest, and over the years now my portfolio currently would be about 80% in equities, approximately 15% in fixed income and liquid assets, and 5% in gold.
And within equities, between the market segments, how are you distributed?
I would have about 50-50, 50% in large caps and 50% in mid caps and small caps. A good part of my portfolio is in mutual funds, where a good part of my large cap exposure would be. I generally don't sell, so I would have in my stock portfolio, I would have some stocks that I bought in 2005 and 2006 and they're still there, if they're doing well.
Yeah. So it's roughly 50-50, half your equity portfolio is funds, half is stocks?
Approximately, yes.
So you said half is large and the other half is mid and small. Which would have seen a substantial bump in the last year or two. Is that where the crowd is also in love?
Yeah. So I think people have become excited about buying a small cap company. People should be excited about a good business, whether it is in large cap or a mid cap or a small cap. When market starts generalizing that all small caps are good, or during bear markets all small caps are bad, when markets generalize, they end up paying the wrong price. That's where, again, you can take advantage of that. When market has generalized that this whole category is good, companies that may not deserve a good valuation may also be at a very high valuation. You're lucky if you hold those and made money, you should take profits from there. When they generalize that the entire category is bad. I remember a few years back, I was on a panel with one of the distributors in one of the conferences, and the person said, I would never advise my investors to invest in small caps. See how badly they have performed. Okay, so I think that was again a wrong generalization.
Was this in 2019 or 20?
Somewhere around, I think it should be Feb or March of 19.
Yeah.
I think that was the time. Yeah.
Have you trimmed your mid and small cap positions in the last year or so?
I typically am lazy in terms of selling. So I kind of endure the corrections when they go to. I do a lot of research and a lot of thinking before I put the money. So I do a lot of research beforehand so that I get a good entry price. Then the outcomes, I only change when I see gross, exaggeration in prices, or when I see a turning point coming in the market. So I don't even review my portfolios on an annual basis or so. My accountant just files it. But I do look at when I feel that markets are at a very crucial turning point or some asset is at a crucial turning point. Those I would change. If there is a company specific issue within small caps or so where I see I need to get out of this position or so, that I may do.
So in the last year you haven't made any changes at all?
For the past few years, my new allocation has been only in mutual funds. So if there's any time that I need to sell something out of my old portfolio, I look at it. Otherwise, it's been mutual funds, and I'm mostly invested in the funds that I manage myself or my team manages.
So you've shifted your MF allocation now to Bajaj?
Yeah, it's in the process of shifting as we are launching new funds. It's just been 1 year.
Right. So now what percentage of your portfolio is in Bajaj funds?
Exact number I may not have as such.
Approximate.
But majority would be shifted.
Majority,
yeah.
Alright. In terms of returns, let's say the past 5 years and 1 year, what kind of returns would you have gotten?
If you enter right at the right time, you would be able to beat the market. So I think apart from the asset allocation changes that come because each asset has its own pace of growing, I think I've been able to beat the returns in each category at least in the last 5 years.
Right, but portfolio overall?
So equities would be not in the 5 years, but if you say 10, 15 years, would be in the high teens kind of a return. As I said, my fixed income portfolio is either high yield, where people were not looking at it, investing in fixed income earlier, or these tax-free bonds that would be there. So post-tax yields should be around 7 to 8% on that, post-tax wise. In gold, I think I have been timing well, and last I was in March 23 when the indexation benefits were expiring. I put a good chunk in gold at that time, and that has benefited me suddenly as the gold has done well. I was not expecting it to do so well so quickly, and this was not the environment I was expecting. As interest rates start going down, gold would start doing well, but that came as an additional bonus that it started doing very well.
Yeah. So to go back to the overall split question, you said 80% is in equities, 15 in fixed income and 5 in gold. So if I had to take and that's roughly been it for the past 10-15 years, or you've changed that quite a bit?
So again, opportunistically, when opportunities come, I would have changed it. But equity would have remained a majority part of my portfolio throughout.
So you would have got roughly a mid-teens kind of return, a CAGR?
I would say between say 17 to 19%, high teens actually.
Yeah.
They would be there. Indian market has given fantastic returns in terms of compounding. I think it's been about 14-16%. We would have done slightly better. I would have done slightly better than that. Again, you learn in the second cycle. You never learn in the first cycle. I started in the year 2000. It took one cycle to see how deep the market can go in fear and how the high the market can go in terms of craziness.
You started in the dot-com bust, then you saw the 2002 to 7 bull run
there. So you can think about how crazy, some companies there, infra, they started at 3 or 4 times price to earnings multiple in 2002-3 and ended at forward 2 year 40 times kind of a multiple. So it was that kind of a move. So you learn through one cycle how crazy it can get. In the second cycle, you actually start creating wealth for yourself. Also, when you start in a bad market, your incomes and savings are not very good. By the second season, where second cycle comes in, you have some savings, and then you can be a little more intelligent or mature investor. And that's when the second and the third cycle you make very good returns.
So your second cycle was 2008, and third was 2013 or...
approximately 13, because I think August 13 was a very bad time for Indian markets because of the taper tantrum that came in. So that was a good opportunity.
But another thing that happens when we start investing in bearish markets is that it colors our psyche and the effects remain for a long time. So do you think any of that has happened with you, or you've managed to sort of clear out that bias?
From 2003, when I got into behavioral finance, started learning about that. I was just an amateur student of behavioral finance. It at least made me very conscious about my biases. And the more I read about it, the more I understood why I'm making these mistakes and why I'm anchoring on a bear market only, why I'm anchoring on a bull market valuation. Things like confirmation bias and all. Whenever you buy something, you start falling in love with it and all that. So those I started realizing more. I'm not saying that I don't make any emotional mistakes, or so I still do. But at least it got me conscious about what biases can come in. And that's why I've been over the years, been able to look at it from a slightly distant view. That my emotions don't get involved there. And very early in my career, I learned that if you put a process around your investing, whether you're doing it professionally or personally, if you put a process around it, it helps you safeguard against these greed and fear and overconfidence that you may run into during investing. So process becomes extremely important.
But I'm wondering if process sometimes overrides intuition, because sometimes you know intrinsically that something is a great buy, but you can't put it in an Excel sheet.
That's a very good point. So what I also understand or see the value in is expert intuition rather than just intuition. Expert intuition is slightly different because an intuition which is honed over a period of time by your experiences that you've seen, and you have consciously tried to learn from those experiences. Investing is a business which constantly gives you feedback about your decisions. If you take those feedbacks positively, you accept where you're wrong, you identify where you went right. And then you start learning from it slowly. That's expert intuition. Then, like some chess masters, after say a career in chess, they look at a game and the moves come to their mind, that this is the move I should make. Spouses, after you've been married for some time, with the hello of your spouse, you can identify whether the mood is good or bad. So that's expert intuition. So expert intuition has a role. I like what Daniel Kahneman spoke about intuition. He said, delay your intuition.
Okay.
First, gather the right data, which is your process. Do your analysis based on the process. Then close your eyes for 5 minutes and see what your intuition is telling you. If you immediately let your intuition intervene and then look at the data, then you get biased. First, collect the data that you want. Yeah. So whenever you are interviewing people also, collect the data that you want about the person. Look at the CV, the experience of that person. And you will have some idea about what the person is like. And then meet the person. That way your intuition actually starts helping you rather than getting you biased into something. I would not tell people invest on your gut feeling. But once you have collected a lot of experiences and learned from its feedback, whether how you did well or you did badly, then you can start using your intuition in investing.
Right. So data first and then you apply the intuition. So Nimesh, now let's turn to your thoughts on two asset classes that people debate hotly on. One is real estate. Have you ever invested in it? How do you think about it?
So real estate as an asset class, I don't feel that I have an expertise in. It's very localized, investment. You have to look at which areas and projects and all that to invest in. So I don't consider myself good at it. I don't consider my house that I'm living in as an asset also or investment. So that's a separate part of my portfolio that I don't even count as investing. If I find that within equities, fixed income, gold, and equities has this different categories, different themes that you can invest in, they give me enough and good returns over a period of time. I don't feel the need to develop that expertise also to go into real estate and start investing there. So I don't know, and that's why I stay away.
Completely.
Absolutely.
But with REITs and InvITs, do you see a good alternative?
Oh, that's a very good point. Yes. Real estate or property companies, some which have good residential portfolios or some where commercial portfolio is very good, and especially REITs and InvITs where you're getting a good yield, those are obviously good investments, and that's something that I'm interested in. So more real estate indirectly through say stocks or REITs and InvITs is I understand better than looking at real estate on its own. And I believe in having assets which are liquid. So rather than real estate directly, which becomes a little illiquid.
Right. But you don't currently have exposure to it either through your personal portfolio, as in REITs and InvITs, or through the fund, right?
So I may have historically bought some of these real estate companies in the portfolio which are small caps and which would have grown over a period of time. So a couple of them, yes, but which are a play on commercial real estate which keeps giving dividends back.
Right, but these are listed companies, they're not
listed companies, not
REITs and InvITs. Okay. Gold, you already talked about some of your strategic moves, but it's a hotly debated thing because some people see it as a dead asset, some people on the other hand are gold bulls, they see a lot of future in it because of inflation, etc. Where do you stand in that spectrum?
I think gold is a good diversification. That's what I believe in. Although I won't say that you can actively trade there, but gold acts as a goalkeeper in your team. So not every asset in your team needs to score a goal and give you fantastic high returns or with volatility. I think gold can be as a goalkeeper in your portfolio. And I believe that at some point of time, when people talk about devaluation of the dollar or de-dollarization, when some of the asset classes go under question because of some crisis or so, and geopolitical issues, that's when gold actually starts giving you the result. At some point of time, I thought the sheen of gold will be taken over by Bitcoin, but the kind of volatility Bitcoin has seen, I don't think many people now consider it as a safe store of value. I won't say extremely pro-gold, but I'm not anti-gold for sure.
Just last few questions on your personal portfolio. Do you have life and health insurance?
Yes, absolutely. That's one thing I recommend everybody, and I myself do. I give adequate cover on my life insurance and for the family also, and health insurance cover for individual as well as a family cover is something that I've kept. And it's even the medical after COVID. Like, people realized that many of them are having lower cover than what they actually require, and that's why we enhanced the cover at that time. So that's one area where I think everybody should be very consciously planning.
Right. So what kind of term, and I'm assuming it's term.
Being an investor, the one plan that attracts me the most is the term plan.
Yes.
And it should be adequate that in terms of something untimely happens, that my family is taken care of. So it's a good amount that I've kept on term. And in the cover, recently it should be about 50 lakh plus in terms of medical cover.
So this is for yourself and then families?
Families. No, it's a family plan.
Floater.
Yeah,
right,
floater.
Right. Last question. Two behavioral biases that you would ask our viewers to avoid, especially in the context of the present market?
Most common biases are confirmation bias and overconfidence. Confirmation bias is a tendency to hunt out data that confirms what you already have decided in your mind. So you would want to meet people who agree that what you have bought is right. You will pick up only those news items which agree that to what your thesis is. You will want to listen to the managements on TV of the companies that you already bought. The problem with confirmation bias is if you have made a mistake, you will never come to know because you're only looking at positives, you're not looking at the risks. And then you will end up losing money, and mentally you will start blaming luck for wrong decisions even when certain negative points were in front of you. You never looked at them.
Yeah.
The second is overconfidence. If somebody is, say, trading or thinking that I know the exact up and down of the market, I'll time it right, it's overconfidence. There are many reports, I think there are some reports from broking houses that say 99% of their traders don't even make FD returns. SEBI came out with a report which said in FNO, 89% of the people making losses. But each trader in the stock market, each FNO player thinks that they can actually...
they are the 10%.
They are the 10% or 1% of the crowd.
Yeah.
So you can think about that 99% are wrong about it. And that's overconfidence, that knowing that I have certain skills that they may not have.
Nimesh, thank you so much. It's been a pleasure speaking to you.
My pleasure. Thank you, Neil.